didn't press it hard enough.
So this is fine.
Yeah, that's fine. Good morning, everybody. I think we're going to get cracking and call the meeting to order, 10:06. And welcome to another Kingston Properties Annual General Meeting. I'm your chairman, Garfield Sinclair, and we're going to kick off as we usually do with a prayer. That prayer is going to be led by our senior executive for operations, Mrs. Tatisha Rowe. Tatisha.
Good morning, everyone, and let us pray. Lord, we are grateful for this another opportunity to meet at our AGM. We ask that you bless our day's proceedings. We are grateful for the past 16 years, and we're asking that you continue to bless us with many more successful years. Lord, continue to help us to be innovative, to be pioneers, to continue to grow and to maintain our core values. Continue to bless our team, our board of directors, our management team, our shareholders, our clients. Lord, we ask that you go with us, protect us, lead us, cover us under your blood, and help us as a country. In your name I pray. Amen.
Wow, I'm just being stage managed here. So we're also streaming on YouTube as well. So welcome to shareholders and other stakeholders who are listening in or watching in on YouTube. And Madam Secretary, I presumed we had a quorum, but you could just confirm that for us now.
Yes, Chair.
Thank you. All right, so you're up, Madam Secretary. We're going to read the notice of the annual general meeting right now. Nicole Foga, thanks.
Thank you, Chair. And as usual, when you finish speaking, I have to lower the thing. Notice is hereby given that the 16th Annual General Meeting of Kingston Properties Limited will be held at Courtley Hotel and Suites at 85 Knutsford Boulevard, Kingston 5, in the parish of St. Andrew in Jamaica, on 12th June 2024 at 10 a.m. for the following purposes. 1, to receive the audited accounts for the year ended December 31st, 2023, and the reports of the directors and auditors. The company is asked to consider, and if thought fit, pass the following resolution. Resolution 1, that the audited accounts for the year ended December 31st, 2023, along with the reports of directors and auditors circulated with notice convening the meeting, be and are hereby adopted. 2, to declare final dividend. The company is asked to consider, and if thought fit, pass the following resolution. Resolution 2, that the interim dividend of US $0.00075 per share paid on May 30, 2023, and US $0.0000797 per share paid on November 23, 2023, be and are hereby declared as final for the year ended December 31, 2023. 3, to be re-elected directors. A, the directors retiring by rotation in accordance with Article 107 of the Company's Articles of Incorporation are Mr. Philip Silvera and Mr. Resworth Burchinson, who, being eligible for election, offer themselves for re-election. I'm not sure I'm going to make it through the whole of this. Mr. Staples, you see why reading is a problem. The company is no, I'm not.
All right, I think we're at the company's article of incorporation. Sorry? Oh, to appoint the auditors and fix their remuneration, the company is asked to consider and, if thought fit, pass the following resolution. Resolution number 7, that KPMG, having signified their willingness to continue in office as auditors, the directors be and are hereby authorized to agree to their remuneration in respect of the period ending with the next annual general meeting. And then 5, to transact any other ordinary business of the company. By order of the Board of Directors, signed by Company Secretary Nicole Folger. Okay. All right. Click on. Oh, I went for click. All right, wait, I prefer to stand. All right, I hope Madam Secretary is fine, good. All right, so I'm up next with my chairman's remarks. First thing I want to do is introduce, again, to those of you who don't know, our esteemed Board of Directors. I'm Garfield Sinclair, not one of the esteemed chairman of the board. You heard earlier from Nicole Folger, who is our corporate secretary. Mr. Gladstone Tony Lewis is here. He's an independent director. Ms. Lisa Gomes is an independent director. Fortunately, couldn't be here today. Mr. Peter Reed is an independent director. Lisa's actually online. Mr. Philip Silvera, another one of our independent directors, and Mr. Resworth Burchinson, another independent director, all of whom are charged with the stewardship of your company. So, key highlights for 2023. We celebrated our 15th anniversary. Last year, we had a year-long series of celebrations culminating at the end of the year with a grand gala dinner where we had a really, really good time. You're going to see more about that during the CEO's remarks. And it was a year worthy, I believe, of celebration. If we go to that next bullet point, we achieved last year a record high total revenue and net profits, which I'm sure shareholders would have liked. And there's some good reasons for that. We've continued to acquire, I think, really solid, highly tenanted properties. We acquired a majority of the Grand Harbor Commercial Center, which is actually shown here in the Cayman Islands. And it says the majority, the place has 38 shops. We've acquired 36 out of the 38 shops. So we pretty much own the entire development, which has done and will continue to do really well for us with respect to returns on that investment. And for that, we paid $15 million. We've always talked and constantly talked about the need to maintain a judicious level of gearing. And so to that end, given this higher for longer interest rate environment, though it looks like inflation is actually beginning to cool now in the US finally with the release of the CPI data there this morning, we believed it was prudent to go out and ensure that we could, basically deliver interest rates and interest expenses that were reliable and solid and predictable rather than going for volatility. So we essentially eliminated last year all of our variable rate debt, got fixed rates in place, so we have a predictable level of interest expense going forward. Again, there is nothing more, virtually nothing more we are focused on ensuring that the levels of debt and gearing that we acquire are absolutely conservative and judiciously applied. To that end, again, liquidity is important to us for all kinds of reasons, not the least of which is to pay handsome dividends when those opportunities arise. but we maintain and continue to maintain healthy cash positions. We're actually now deploying a bit of that cash towards the end of last year with the acquisition of Grand Harbor and into this year as well with some more acquisitions you will hear about in due course. But one of the things we focus on as well is ensuring that we maintain healthy liquidity positions. And then from an overall governance standpoint, we received an A rating in the JSE's Corporate Governance Index ranking for listed companies, which again suggests that we're not only focused on the economic returns to our shareholders and stakeholders, but we believe that good governance leads to generating solid returns at the end of the day. Is somebody else changing this? Oh, you are. So let me do this for click on. All right, so a couple of quick facts. Rental income last year, highest it's ever been, nearly $4 million. Net profit, highest it's ever been at $4.6 million. Inclusive, frankly, we're transparent here at Kingston Property, inclusive of some revaluation of our assets. But again, conservatively, we believe applied, and the valuations we're talking about are all discounted cash flow valuations, not sort of finger in the ear kind of guesses, discounting actual cash flow yields in order to arrive at appropriate discount rates in order to arrive at these valuations, and we've been very conservative in applying those year over year. Our funds from operation, another metric we, and in fact you as shareholders, should follow very closely, because we're essentially paying that all out as dividends every year now, as you will see in our dividend payout schedule. I think our policy is for 90% or more, but for instance, last year into this year, we've probably paid out our entire fund from operation as dividends, and that just basically tracks the amount of cash the business is throwing off. Cash provided by operations, that's from your funds flow, your cash flow statement in your financials. We're doing now from operations $2.5 million. We're paying gross dividends last year of the 1.4, as I mentioned, virtually our entire funds from operation. Our dividend yield is at 3.1%, which is very good. The assets we have, the buildings we have under management, 462,000 square feet, another 112,000 square feet of land under development, and our goal, as you know, is getting to 1 million square feet under management. And our occupancy levels, one of the things obviously we track very carefully and ensure that in order to keep that number as high as possible and as close to 100% as possible, is that we diversify our tenant roles and lists, so we're not sort of dependent on any one business or industry, has enabled us to maintain a 98% occupancy rate overall, and we're just going to look to improve that. So, stock price versus book value. One of the things we've always said as a management and our overall governance team is, we obviously have a vested interest in ensuring that the stock price reflects the value, the underlying intrinsic value of the business every day. But all we can focus on is increasing and enhancing that intrinsic value. The stock price is going to have a mind of its own. It's based on animal spirits and emotion and all kinds of other issues. All we can focus on is passions, Mr. Silvera, passion. All we can focus on is driving intrinsic value. Growing and growing the underlying intrinsic value of the business. So what we like to see is a stock price that at least, reflects the book value, the underlying book value of the business. And we think, given our stewardship over the years and our consistent ability to deliver returns for shareholders, that we should have a premium. We should be generating a premium on that based on what our forward numbers are to be looking like. And I think we've demonstrated, and you will see that we've demonstrated the ability to generate better and better forward earnings in the past. And so, as you can see, since 2019, this is a 5-year look at the comparison 2019, we've had a book value per share that has been less than our stock price, right up to about 2022, when inexplicably we've landed the best results. We started landing the best results in the business, yet for some inexplicable reason, our stock price has gone below book value and has remained there. It's moved above there now. I mean, there's been some activity in the market more recently that has pushed it now above. So this is not contemporaneous. Right now, we're actually trading at or around book, but for some reason, there was that switch there. We can't explain it. Like I said, we can just focus on the driving intrinsic value, and that we have done from a book value standpoint. As you can see, that's moved steadily up from the $6 it was back in 2019 to $8.39 today. So we just like to show that at the price it was then, we're undervalued, clearly undervalued. But we're not undervalued anymore. I don't know what the price is today, but it's hovering. It's at about $8.50 today, I hear. So it's actually exceeded book a bit, but that's where we believe it should be. And even though the price has underperformed, the overall value being attributed to the business by the market continues to beat the overall market, which is what this slide shows. We moved in from 2022 to 2023 from 775 to 780. That's about a 0.5% thereabout. About 0.5%. Whereas the main index for the same period of time is down about 30 grand, about 8.5%. So we're well ahead of the overall market there. But again, that price, even though it beats the market, didn't reflect at the time certainly our book value. It does now, so the market is finally catching up. Another metric and KPI that certainly matters to me a lot and should matter to shareholders quite a bit is the earnings per share. Share totals and outstanding share totals are going to move around as we engage in capital market, capital fundraising transactions. What you want to ensure is that your earnings per every one of the shares you earn continue to move in a positive direction. And that is what this slide shows, is that we continue to focus on and drive growth in earnings per share. We had an 8% increase in US dollars, and in J dollars, because of the valuation issues, there was actually a 10% increase in earnings per share. So every major crucial metric with respect to earnings, you can see your company is driving in the right direction. Dividends declared, another thing that stakeholders should be and shareholders should be clearly concerned with, is, as you can see, we've continued to increase the returns to shareholders. Not only have we engaged in fairly intermittent share buyback exercises, returning funds to shareholders who want liquidity for whatever reason. Dividends declared continue to move in an extremely positive direction, taking off again in 2022 and in 2023 as the results have gotten better and better and better. Showing again our commitment, our absolute commitment to knowing why it is we are here, to return yields and good, solid, competitive, risk-adjusted yields to our shareholders, and that's what that continues to show. So, finally, what are the key strategic imperatives? We met as a group in a strategic retreat some time ago and set out some key drivers that we want to focus on, just keeping it as simple as we possibly can. There's an elegance and simplicity that I don't think is fully appreciated by the market. We focus simply on a couple of key metrics and are driving towards achieving them. Assets under management, that's the total portfolio of assets we manage, land, buildings. We are at 71 million at the end of 2023. Our target, as we stated at the retreat, was $100 million. And that's US dollars, by the way. We are well on the way to achieving that target based on the activity that's planned certainly for this year. Return on average equity, let's keep that stable and heading up. 10% we think is a solid return on average equity. It's what our 2025 target was. We hit that in 2023. So I know as demanding shareholders, you're going to say, well, let's blow past that. No, that's easier said than done. However, I think if we maintain it there and continue to go higher, we would be doing a pretty good job. And funds from operation, as I mentioned earlier, critical metric because it determines essentially what we are able to pay out or what we've agreed to pay out as dividends. And that was $1.4 million last year. And our goal for 2025 is to be able to distribute $2 million in dividends. So that is what Kevin and Andre and the team back there who will be introduced to you later is charged with doing. So that concludes my presentation. Thank you, ladies and gentlemen. I'm going to turn you over now for some more granular. Thank you. So I'm going to turn you over now for some more granular financial information to our esteemed CFO, Andre Francis. Andre?
Yeah, good morning, everyone. And yeah, man. Yeah, it's a pleasure to bring you the financial highlights for 2023 and to just put that in context by comparing it to our 2022 results of operation. Yeah, man, thanks. Yeah, man, hi. I'm here. No change, right? All right, cool. All right, cool. So, so for 2023, the year ended December 2023, we reported a 15% growth in our rental income, and that reached 3.8 million, as the chairman says, compared to the 3.3 million in the year before. A strong growth in our rental income driven by our rental rates, improvement in our rental rates here in Jamaica and in the Cayman, where we have the properties, and also the expanded portfolio. So the chairman spoke about Grand Harbour adding to the portfolio at the end of 2023, and that drove us that growth, nice growth in rental income. In addition, we also had our total revenues being $7 million versus $5.9 million the prior year, and that's a 19% growth in overall total revenue. A big driver in that would have been the increase in our asset values. We recorded a $2.6 million uptick in our fair values on property, and we've also had a gain on sale of about $400,000 from the disposal of one of the properties in New Kingston, the Dumfries Road property. So we are also realizing the gains that are building up in these asset values. So those are the main factors that drove both the rental revenue increase and our total revenues in general. Now, when we adjust the operating income with our operating expenses, we were at 25% increase on operating income in 2023 compared to 2022, right? We hit 2.5 million, and this is pretty much driven by the higher rental revenues and also in conjunction by the containment of costs. So our operating costs increased by a mere 3% for 2023 when we compared to the growth in revenues of over 15% on our operating revenues, right? So this operating revenue was achieved with a margin of 61%, a net operating margin of 61%, which also demonstrates the strong management of cost. And as we see in terms of historic, this is a steady improvement that we've had in terms of how we generate operating income. We've grown that percentage margin from 35.39 way back in 2018 to the 61% now. So that shows that we build the revenues, but we are also managing cost, operating costs at the same time. So at the EBITDA, we were at 23% above prior year. We hit 5.4 million in EBITDA last year versus the 4.4 in the previous year. And again, a major driver of that would have been the uptick in rents plus the increase in our fair value and our gain on sale. So that we continue to be strong there. And when we look at the net profit level, the EBITDA was slightly tempered by the net finance costs, which grew to 681K, about 41% increase. But this increase in net finance costs is pretty much an increase in our interest costs, interest expense. And this is partly to fund the growth in the asset values that we've talked about, a necessary aspect of the business. But one of the things that we have done is use the short-term financing, short-term investments to kind of mitigate the impact of these net finance costs. So our investment income for the year actually grew by about 46%. Just from managing short-term financing. Net profit for the year, we did hit a record net profit for the year of 4.6 million this year compared to the 3.8 million last year, and that's what the chairman spoke about this year. That's a transition of all that revenue to the bottom line. So we grew net profit by about 22% in 2023. So I mean, we did that in 2023, but it's a continuation of a strong growth and value creation within the company. So when we look at our 5-year compound annual growth rate over the last 5 years, rental income has grown by about 18% annually, net operating income by about 29% annually, and our net profits has been growing by about 16% annually over the last 5 years. So, continued strong growth. Our funds from operation, which is another value that we are creating for you, the shareholders, is growing as well, and this is a very important metric. Increased by 4% last year to 1.4 million, and as the chairman says, this is the metric that is used to determine what the dividend payout ratio is, and so that's another strong one for us for 2023. Yeah, so just turning to the financial position as at the end of 2023, so this is the financial position as at December 2023, our total assets under management would have grown to 71 million over the 56.2 last year. That's a 26% growth in our asset base. And again, this is driven by building that portfolio of investment properties. So investment properties was $67 million last year, at the end of last year. And the main driver in that would have been the acquisition of Grand Harbor, which is our largest acquisition to date since the inception of the company, single acquisition. And you see the performance that it did coming in late in the year and the effect it had on revenues. So our investment property continued to be a strong growth. Now, the asset base, the growth in the asset base is financed pretty much by a mix of debt and equity. So our loans payable, as you see, has grown to 22 million as at the end of December from the 11 million last year. And primarily this went into financing Grand Harbor and also to finance some property improvements, especially in Cayman. We've improved the state of one of our property, Harbor Center, state-of-the-art, energy efficient, and kind of ready to attract better rates in that market. And we've also, but one of the things that we've done, and the chairman mentioned, is to kind of mitigate the impact that interest costs will have on our bottom line and how that fluctuates. So we've actually switched out all of our high cost variable rate debt and refinance those with lower rate fixed interest debt, and that will have some stabilization effect on our revenues and our bottom line. So but another thing to note is that even with the higher loan balances, we still continue to maintain very conservative loan ratios. So our loan to assets was just 31% in 2023, and our loan as a percentage of investment properties, because that's a primary purpose for the loans, just 38%, and our overall debt to equity was at 46% as at the end of the year. Another point to note in that is that we're still well within our loan covenant ratios. Or debt to equity sort of max requirement is a 5-to-1 in terms of our loan agreement. On our LTV, or loan to value constraint, would be at 70%. We're well below that when you look at our ratios, which mean we also have the ability to leverage up and to grow the business even more to achieve the target that we talked about in terms of the 100 million of assets and to grow our square footage under management. Right? So the other side of it would be our total equity, and our total equity has grown by about 7% last year to 47.9 million, up from the 44 million last year. And the main driver of that would have been the growth in our net profits for last year, net of the dividends that we've paid out. So all in all, a strong year. This actually represents a book value per share of about $8.54 Jamaican, or 7.76 versus 7.76 last year. So all in all, a very strong performance for 2023. And just finally, to kind of recap some of the major operational metrics for the year, we have our net operating margin was 62%, and that's a growth over last year. Our EBITDA margin was at 76%, again a growth over last year, and our profit before income tax margin at 69%, also above last year. The rental income as a percentage of portfolio, the investment property, was 6%. This is in line, even though we had the growth in the asset base. And our operating expense as a percentage of rental income was at 40%, shows efficiency in the expense management. Our debt to equity was at 46%, as I said, and our debt to asset, 31%. And our debt to investment properties for the year was at 36%. All right, so that's pretty much the overview of the financial results for 2023. So I'll turn it back over to the chairman to continue. All right.
Thank you, Henry. I'm not sure you could actually look at this impressive performance and not buy more of the stock. How is it trading right now, David? I know you're watching. All right. Putting your buy order, I'm sure. All right. Morning, everybody. Happy to see everybody here, standing room only. I was just commenting to Nicole that we probably need to get a bigger room, because it's happy to see that there's a lot of goodwill in KP, and that's demonstrated by you all being here. So thank you for being here. And hopefully we'll continue to deliver these results, so you will stay with us and add more, and we'll add more shareholders as time goes by. I want to just introduce some of the folks that are here. Our philosophy is that, with good people, you'll always deliver good results. And part of that has to do with the team that we have here. So the chairman introduced the board of directors, but I'll introduce my team. And you've met two already so far: our CFO, Henry Francis, our senior executive of operations, Tatisha Rowe, and the other senior management cohort here, Nichelle Spence Latibadir, who is our General Counsel and Compliance Officer, Roxanne Kelly, who is our FC, and Javon Rose, who is our Property and Projects Manager. And then the rest of the team, people are surprised that we're managing a portfolio of $70 million US in assets, and we only have 12 people managing. So the rest of the team. So let me recognize the rest of the team, starting with our junior analyst, Lemar, who is ably running through the slides, Nichelle, Jessica, Rachel, Andra, who joined the team this year, Tanya, who's always been with us. Hope I haven't missed anybody, but happy that everybody came out today and is here to support this endeavor. The other thing I also recognize are auditors, KPMG, who've been with us for a very long time, and we're happy with the support they've given to our organization. And Karen is here, and she'll go through the audit opinion later on the presentation. Or social media marketing team, Easel Media, they're here. And again, we mentioned that we're streaming live on YouTube because there are some shareholders who couldn't be here physically, but they're joining us via YouTube. So they're manning that as well. And our graphic artist, Camille, I've not seen Camille. So again, there are three pillars in the success of this business. Not just the success, but the sustainability of this business. It's our people, the properties, and those deliver those excellent profits that we just went through a while ago. Like a pyramid, I mean, when you're building a structure, you need to have a solid foundation, and that starts with the people. I mean, the team that I just introduced to you is a very hardworking team and dedicated team, and we continue to invest in that team for their own growth and development and to contribute to the development of this company. Once you have assembled a very good team and you retain that good team, you go out and find some excellent properties, which I think we've done over the years, which is what has led to the great results that you have been able to witness today. Another thing is that we've always been sort of at the forefront of adopting global best practices. So we're one of the early adopters of ESG reporting. And you'll see that in the annual report, and I'll run through some of our ESG achievements for 2023, as well as some of the targets that we have going forward. And we kind of examine how our policies on, the environment, or what our corporate social responsibility activities are, and what our governance policies are, and see how those help in shaping this company and to support that same pyramid of sustainability that we talk about here. So on to the team, the people. KP has a strong culture. I mean, our culture is about strong policies. We were, one of the early adopters in Jamaica, not globally, of things like paternity leave, or, focusing a lot on wellness and counseling and ensuring that we have, team members and even working with the communities to ensure that people are operating efficiently. We attract some of the best talent, and we try and retain them by investing in them. And we do that through training and development. And as part of the whole thing, there has to be a balance in life. So we do have a little bit of fun. It can't be all work. That good balance is what I think keeps us gelling together as a family, as Tatisha loves to say about us. In terms of the environment, we are very focused on the environment. Again, this is one of the first things that we started to report on in our annual report. And we decided that we wanted to achieve gold status. We wanted to make our properties green friendly. So we partnered with NEPA through their Green Business Initiative to try and make some of our properties green certified. In 2022, we got a silver rating on our properties, and in 2023, I'm happy to report that we got a gold standard award for our properties in the NEPA Green Business Initiative in 2023. That was obviously through the hard work of the team members, and again, I want to salute that. In terms of some of the other things that we've been doing, We've continued to work with Recycling Partners of Jamaica, and we not only are looking at recycling at our properties, but we take it to the community level. So wherever we have properties, we work with the communities there, and in terms of sharing some of the green initiatives that some of the things that come out of that program, but also things like recycling and how you use certain resources. Those are some of the kinds of projects that we work and build awareness in the communities. And we start in the schools primarily, because once you start at that age, then certain habits develop. So we've gone into like recycling projects at some of the schools, and even in terms of some of the activities that we do in our corporate social responsibility in the communities. We've also engaged consultants to look at solar projects. We collaborated with one of our tenants at Red Hills Road to install a solar project at our property. And we've also engaged a consultant to look at all of our other properties, and we're hoping to go solar certainly by 2030 at all of our properties, but it's an initiative that we're working seriously on. And I say 2030 because we subscribe to the UN Sustainable Goals 2030 initiative, and we particularly focus on specific items, zero hunger, good health and well-being, quality education, life on land, and climate action. So any of our activities that you see us do in terms of our corporate social responsibility or our environmental initiatives, those are centered around those 5 specific UN Sustainable Goals items. So turning to social, I think one of our biggest achievements in that area was last year we were able to collaborate with Food for the Poor to donate a house to a resident in Callaloo Mews, which is adjoining one of our properties on Spanish Town Road. I think this was a particular initiative that I'm very happy that we were able to get done. It is the biggest thing, I'll repeat, the biggest thing we've ever done for someone. I think she was quite elated to have gotten that house. And what we're happy to report is that this house is fully solar. We were impressed with that too. So that's one of the other reasons why we got involved in this project. Now we're hoping that we will have some budget to continue to do this on a regular basis going forward. But it is an initiative that we're quite proud of last year. Again, we work with a lot of the communities, so we work in terms of some of the sporting activities. Because again, I see it every year, and I say, because I fundamentally believe it. If you work with the communities around you, they will continue to support you. Because, they will look after your property all the time. So we do community engagement projects in communities near to where we own properties, and we work, as I mentioned before, with some of the schools in terms of recycling. Now turning to governance, another critical element of ESG, and the chairman went through a number of things, but just to highlight, one of the things that we do is that we ensure that the board does constant review of all our charters, all of our terms of references for board and subcommittees. We, as a company, decided that we were always going to be adopting global best practices in whatever we do. When the company was formed, although there was no REIT legislation, we decided that we're going to adopt the policies and principles of a REIT. The same approach we take to governance. So we do focus a lot on trying to achieve the best standards in governance, and the Stock Exchange has recognized that, again, with our rating or A rating in their corporate governance index. You don't see us winning those big awards when they have the thing at the end of the year, but I can tell you that our corporate governance index score is one of the highest of all the listed companies on the main market index. We adopt the PSOJ Code of Corporate Governance, so we do the comply or explain principle, and most of our policies comply with the corporate governance code of the PSOJ. And as I mentioned before, we received an A rating, and we'll continue. The other important aspect of governance is transparency and engagement. So we have 4 like this. I mean, of course, an AGM is a required activity, but we ensure that we are engaging with all of our shareholders and prospective shareholders, which is why we're streaming on YouTube, for example, so we can have a wider reach, because it's very important that you understand everything that your company is doing, not just the results that you've seen, but some of the things that we are planning to do. And I'm going to speak a little bit more about some of the plans going forward for this company. Again, just quickly, some of our ESG and sustainability goals for going forward is development of more rainwater harvesting facilities at our properties, installation of solar flood lamps to replace the fluorescent lamps, which are again more cost efficient. Installation of translucent roof sheets at some of our properties to bring in more natural light at our warehouses. Planting small root trees with low dependency on water. I mentioned more stakeholder engagement that is working with the communities around the properties that we own. Solar projects, continuation of environmentally friendly practices, and increasing partnerships and donations to volunteer and increasing our volunteer hours. Those are some of the key ESG targets and goals that we have as a company going forward. Now turning to property, the other P. We've spoken about people, let's talk about property. As Henri mentioned, we did spend some funds last year, which is something that we do every year, in improving our plant and property. So we did spend funds on improving the Harbour Centre property in Cayman to make it more energy efficient, and also it has a cost-saving element to it. And it also makes it a more attractive building. I mean, I get calls from people in Cayman who just rave about how the building looks now that we've made some of the changes there. We painted some years ago, we changed the windows out to more energy efficient windows, and that has made the building a lot more attractive. And once it becomes more attractive, you attract more tenants, or higher paying tenants, more likely, and that will lead to higher profits. Again, everything is all linked. We have ventured into greenfield developments, and we're happy to report that we do have approval for the construction of 14 mini warehouse units at our property on Rousseau Road. We're currently in discussions with the contractor and the other professionals to finalize those, but we're hoping to break ground on this project, fingers crossed, by September of this year. Should be a one-year project, so hopefully by next year, this time where we're at the AGM, less than a year, we're able to say that we're completed that project, but we're working towards that. Again, on the properties, we've had tremendous growth in this company in terms of our property portfolio over the last 10 years. At the end of 2014, our property portfolio was equivalent to $8.6 million US. Closed 2023 at $66.8 million US, and that includes all the property, physical plant, buildings that we own, as well as some investments we have through real estate partnerships. And Henri mentioned our acquisition of the Grand Harbour property in Cayman Islands. We saw an uplift in fair value, which was also a contributor to our $4.6 million in profit, fair value uplift of $2.6 million. We sold the Dumfries property as well as the last set of condos in Miami. Both netted us $400,000 in gain. Now, sorry, just going back to that chart. If you notice the growth in the property portfolio, and I'm particularly singling out between 2014 and 2015, again 2019 to 2020, and 22 to 23, those were years where we had big jumps in the property portfolio. Those are largely driven by capital market fundraisers. In 2015, we had a rights issue. In 2019, we had a rights issue. And in 2022, we had an APO where we raised funds. Typically for any, and let's call ourselves a REIT, although there's no REIT legislation, every REIT constantly raises funds to build their portfolio. So this is a fundamental part of our business, to be always raising capital, using the capital markets in different forms, whether we're using debt or some other type of instrument, But largely, we've done it through equity to continue to grow the portfolio, and this is something that we're going to have to continue. We do have a goal to get to $100 million in assets, and for us to move from the 72 million that we are now to get to 100 million, obviously we'll have to use the capital markets again to continue to expand the portfolio. Puts me on the spot there. So back on the property, I mean, we've made a strategic shift in how we've invested in our property portfolio. Again, with the addition of Grand Harbor in 2023, our holdings in Cayman expanded to 55% of our total holdings. Jamaica is at 33%, and we're 7% in the US. Typically, we're looking to do more acquisitions, some in Jamaica, some in other markets. So by the end of 2024, this graph is going to look very different than what it is. Also, in terms of distribution, most of our holdings are between office and industrial properties. That's the largest concentration. We do have 15% in retail, 7% residential, and 14% is other. So that would include land, some of our real estate partnerships, and another category of properties which we have called schools, because we do have holdings where bulk of our tenants are, it's an educational facility. So speaking of the tenant profile, most of our tenants are largely from the government sector, the financial services sector, schools or educational facilities, as I mentioned before, restaurants, manufacturing and distribution entities. That's the tenant. So we have a very diversified tenant pool, and that works well because in any environment, you may have one tenant that may do well at one time, another may not do so well. So there's balance in the portfolio in terms of our tenant profile. Governments will always be, good tenants. They tend to stay in the buildings for a long time. They actually pay. Some may say, not us, some may say they pay late, but they actually pay. I don't know of any government tenant that has ever asked for any rent abatement. Argentina is a different animal. But we're happy that the government tenants that we have do pay, and that's why we're able to generate cash flow and pay dividends. In terms of what we're going to be doing and why I say that profile is going to look different going forward is that we do plan as a strategy to monetize some of the assets. As you have seen from our first quarter results, where we have listed some of our assets in Cayman for sale, some of the units held at the Tropic Center, those have been listed for sale, and already we've gotten significant interest. We're hoping to close on some of those units in short order. We are looking for opportunities in the UK. As we said, we continue to scout deals in that market, and we're hoping that we will be able to close on a transaction there soon. And as well, we're looking at sale and leaseback opportunities here in Jamaica, as always, because our business has largely been built on sale and leaseback transactions, dating back to where our current head office is on Red Hills Road. We acquired that building from Henkel on a sale and leaseback transaction. We acquired a property on Spanish Town Road on a sale and leaseback transaction. And we have another one that is pending, which we'll hopefully be able to make an announcement on in very short order. But going forward, you have to take into consideration what is happening in the environment. And I think the U.S. economy is a critical one, and everybody sort of watches what is happening in that market, because that determines sort of where the wind blows for every economy. It is a driver of global economics. And there is an interest rate watch on now with the Fed. You've seen two other central banks already bit the bullet and cut rates. We're watching to see what the US Fed will do. The Bank of England, for example, is trying to stay out of the fray because of an election period. But I expect that the Bank of England will cut rates at some point by September, I believe. And again, the US will follow suit fairly soon. Once interest rates fall, then it's likely to see some turning in the commercial real estate market. I don't think it's going to happen as rapidly, but it certainly will send some signal of confidence in that environment. But for as long as interest rates remain high, we still see opportunities because rates are high, and there are some commercial land real estate holders who are in distressed situations. So we're looking for those opportunities to gobble them up, because we've always done well when we've acquired distressed assets and added them to our portfolio. So we're always scouting for those deals, and this is particularly why we need to move quickly in terms of closing on several acquisitions, and that's what we're working towards. So just to leave you on some things, we're hoping to get our portfolio to at least $80 million US. We ended last year at 71.5, roughly 72 million. I think at the end of the first quarter, we're at 72 million in assets. We're hoping to break the 80 million mark. Our target is to get to as high as 85 million by the end of this year. Again, by 2025 to get to 100 million, we will have to do some sort of capital market activity. We're not sure what form that will take just yet, whether it's going to be a rights issue, or AP, or a pref share, or some sort of capital market activity to take us up to the 100 million mark. We've said as our strategy for the last 2 years that we're moving away from the static investment strategy and becoming more dynamic. And being more dynamic means that you're going to be monetizing more of the assets. Monetizing the assets, traditionally people just think that you're going to just sell a property, but there are different ways of creatively monetizing assets. We have been working with some of the brokers to try and come up with creative ways. I wish they would be a lot more creative. Yes, that was a jab. In terms of assisting us in being more, being able to monetize some of the assets that we have in our portfolio. We are going to be doubling down more on our core investment strategy, which is to target immediate cash-generating properties with high cash-on-cash returns in US dollars. This means this is a de-emphasizing of things like greenfield projects or real estate partnerships. Those take a long time to get to cash flow, and cash flow is a critical component of our business because we want to be that company that is known for paying consistent and high dividends to our shareholders. And to achieve that, it means going back to our core business, and which is the core business that has done very well. There's a lot of folks who have this belief that greenfield development or ground-up development projects give you this high return, but from our experience, our investment in value-add properties, for example, have given as much or even higher rates of return on investment. When you go and buy a property that is distressed, you go and you make some renovations, change your tenant base, change your rent profile. That has given us a much better return and in a quicker time than going the route of greenfield development. So this is why our strategy remains focused on that, and we're de-emphasizing any look at greenfield projects. Partly the reason which explained why we disposed of the Dumfries Road property in New Kingston last year. Again, we're widening our reach, moving outside of the hurricane belt, and I've mentioned the UK is a market. UK is a market that we are very bullish on. We look at markets that we see some sort of distress, but if anyone thinks that the UK is going to disappear off the face of the earth tomorrow, then we should all pack up and go home. That's a market that we like, and again, we'll continue to pay consistent and high dividends. The final thing I want to talk about is our stock price. I think the chairman touched on it in his presentation, and we looked at how the stock price has moved relative to book value. Typically for REITs, and we do a comparison with, again, we try and adapt global best practices. So when we look at our comps, we compare ourselves to how mainly US REITs have performed, because there's a lot of data on it. And we look at how we compare on a number of metrics. One of the metrics we notice is that US REITs tend to trade at a premium to book value. And I think KP should be trading on a premium to book value. And I'll tell you the main reason why is because of how conservative we are in valuing our properties. We tend to, discount, you remember at the end of the day, the board decides what the value is. And we've opted to take a very conservative approach to valuing our properties. So even if we have a property where, valuer says, yeah, that's worth $100, we believe that there are other factors that can affect that value when you move to dispose it. Your transactions cost, the market could have shifted. So we take a very conservative approach to it. What we have seen though is that while we take that conservative approach, when we do move to dispose of it, we are able to realize much higher than what we're carrying those properties at. So we do believe that our property portfolio as it is very undervalued, and that is one of the main reasons why I think KP should be trading at a much higher price than it currently is trading. The other thing I want to talk about is we did an APO 2 years ago, and there was a general consensus that APOs are bad, the stock price is going to be languishing forever, we're going to be dead. Well, KP stock price, despite what has happened to the overall market, is trading at 13% higher than the APO price. So if you bought in the APO, you're 13% better off than if you had bought some other listed stock, because the general market itself is down 17% since that time we had the APO. And if you talk about the general market, that is made up of a lot of stocks. Some of the high capitalization companies make up that stock, that index. So if you had bought some of those stocks, you are probably down. In fact, you'd probably be down more than 17%. Having bought into the APO, you are 13% better off than if you had bought any of those stocks. So I leave on that final note about the stock price. I'll leave where I started off, that you can't see these results and not want to buy more.
All right, thank you, Kevin, Andre, really appreciate it. Stakeholders, as you can tell, we have an acute focus on value creation for shareholders. It just runs through everything. We talk about everything that we share. That is our focus here in this public company. Remember, those of you who've been with us from the start will remember that we begun as a little company back in 2012-ish that raised $5 million on the exchange at the time to buy 5 units in a condotel in Trinidad. Some of you may not have been around then, but that is how we begun. Today we are a $71 million company and headed to 100 million. So, and that is because the focus has constantly been growing the asset base, growing value for shareholders. So we're at the point now where we're at questions and answers, and the hands are going up fast and furious. I'm sorry, this hand went up before yours, Mr. Staple, but you're second for sure. There's a mic around that you should be able to grab. There it is.
Yes. Hello. Still morning. Good
State
morning.
your name and
Denise
I know your
Williams.
name, but
yes,
yeah.
Denise Williams.
Yeah, thanks, Denise.
I have 2 questions. The first one is that a lot of the commercial real estate news has a tagline: "Stay alive till 2025," and the idea is that the commercial real estate is not only on the verge of crashing, it's going to take a lot of small banks with it in the US. So there's this idea that the pain is coming for companies who cannot stay alive till 2025. Now, clearly, you have outlined that you have changed your interest rate profile so that you're fixed and you're able, and you have cash and you're ready. And Kevin has also said that you are taking a position that you're going to gobble up whoever doesn't make it to 2025. Okay, that's fine. But I would love to know your views on the idea, though, that commercial real estate is so vulnerable that it can take the banking sector with it. So I would love to hear your thoughts on that. The second question I have is in relation. Oh, you want to write it down? Oh, okay. All right. My second question is in relation to, again, asking for your comments on why you moved so aggressively away from residential, in that it's only 7% of your mix. You did start when, many years ago, that it was residential, and then you bought heavily in Miami, and now you've divested aggressively out of Miami, but you've gone aggressively to Cayman. So just, the idea of why, in a sense, you've turned your back on residential. Come again?
All right, David, hold on. Just let
Okay.
let her
Well,
finish.
right. So it's more of a commentary on the market. So in both questions, you have outlined your strategy. So I'm not. There's no confusion there. But it's just for those of us who are not in your meetings to kind of understand what underpins your strategy, particularly in the second question about residential, particularly given the massive build out of residential around City Kingston. So thank you.
Yeah, wow. That's a mouthful, Denise. Thanks. But, incisive questions as usual. Let me take the last one first. We have not abandoned residential property, for instance. We have two fairly big partnerships based in Atlanta, which is a city in the U.S. that we like, that are both residential property based. So we are not out of the residential property business. So I'm coming to that. With respect to how we started in Miami, we actually were a bit lucky, foresighted as well, but I would say a bit lucky to have gotten into that market at the bottom of the market. The bottom had fallen out of the U.S. residential property market, particularly in southern Florida in 2012 or 13 when we jumped into that market and I think bought 25 or 30 apartments down in downtown Miami. And we rode that wave for quite a while, and I think, again, fortuitously disposed of those properties as the market turned, which it did. I mean, look, markets are cyclical, and one of the things we have to do as stewards of your capital is you can't time it perfectly. You're never going to get in at the absolute bottom. You're never going to get out at the absolute top. But you can't sort of be wedded to any particular strategy or asset class. You really just want to be able to move where the opportunity is. And so we saw an opportunity in the commercial real estate space, diversifying that commercial real estate space, diversifying the jurisdictions, the geographical jurisdictions where that commercial real estate space was, also diversifying the tenant base in those commercial real estate spaces. And so that is why we have largely shifted. And again, it's office and retail as well. So we've obviously mixed up the asset classes as well. And as you can see with our performance, it's been resilient. I mean, throughout the pandemic, we had a global pandemic that virtually brought the world to a standstill. We continued to operate as if nothing had happened. We generated dividends. Our dividend yields continued to move up through 2020 and then exploded in 2021 after 2020, right after being in the teeth of the pandemic. So I think our model has demonstrated tremendous resilience through some fairly tough and large exogenous shocks. And so I wouldn't get wedded to a sort of particular type of real estate asset class. What I think we are charged with as stewards of this capital is being able to ensure that we are geographically and asset-wise diversified enough to be resilient. And by be resilient, meaning increasing the dividends we return to you every year, year in, year out, and not having to say, oh, there was a global pandemic this year, for instance, which stopped everything else in the world, so we can't pay you in the dividends. We haven't done that, and we're definitely not going to do that in the future. And then the idea about the commercial real estate market bringing down the banking sector. Look, some banks who are overexposed to that sector are going to feel a tremendous amount of pain. The U.S. banking sector is several $1 trillion big. It's not going to bring it down. But there are, I think, institutions who are overly exposed to certain commercial real estate. Again, not all either, right? Not all commercial real estate. Certainly the office commercial real estate space in certain areas are struggling, and institutions that are overly exposed to those are going to feel quite a bit of pain. Some might even go out of business, but again, that is part of normal economic cycles. What we believe we have to keep doing is making sure from a debt standpoint and a debt exposure standpoint, we remain prudent, that the cost of that debt doesn't rise faster than the revenue we're generating from the assets that debt helps us buy. And I think we've shown through our net operating income numbers that we continue to ensure that that ratio is about right. So yeah, I mean that's what I'd say about the threat of commercial real estate. There's no question the pandemics changed the way we're all going to work going forward. But I think the evidence is that a ton of businesses are requiring people to get back to work. Now, there was a sense that nobody would be going back to work, everybody would be working from home. Nothing could be further from the truth. Most businesses are now saying, no, we want people back in the office, the best way to collaborate, the best way to build a culture, best way to get people mentored. And so you can't just work remotely. And so we don't think the commercial real estate business is dead. But there are going to be pockets of struggles, and the institutions overly exposed there, we think, are going to struggle as well. Yes, Mr. Staple.
Chair,
I know you're going to carry me through there.
Before I ask my questions, I have a couple of observations I would like to share with you.
Commendations, I'm hoping.
First of all, I would like to congratulate you and your staff members for the hard work they have put in. Kevin has worked very hard.
He has. Thanks, Mr. Staple.
And continues to work very hard as far as Kingston Properties is concerned.
Yes, sir.
And I appreciate what they have done as employees and as members of the board. You have used your expertise to generate what you have generated. A good management discussion and analysis, and I would like for you to continue doing that. Mr. Chair.
Yes, sir.
If you turn me to page 19, I noticed that your net profit for the last 3 years is in a negative amount. Why is this so?
Sorry, but net profit in the last 3 years.
3 years, yes. In 2023, it was 21.5 million, 25.5 thousand US. And in 2022, it was 84.
Sorry, what are you talking about, Mr. Staple? The net profit number?
Yes. Net profit.
Right. You sure you're looking in the right column or row? Because net profit for 2021 was 3 million, for 2022 3.7 million, and for 2023 4.6 million. So net profit has grown. If it's a net profit.
I'm looking at.
Huh?
No. He's over here. So
No, if it's net profit you're talking about,
22,
then that has only grown over the last 3 years.
Okay. Okay. All right. Okay. Sorry about that.
So you meant to commend us. You meant to commend us for that. Mr.
Yes.
Just checking.
Mr. Chair.
Yes, sir.
Sorry about that.
No problem. No problem.
I looked at the wrong column.
See,
Your audit.
because you want to lash me, you know, you want to lash me too bad, you know, Mr. Staple.
Our audit fees for the year, current year,
What page you on? What page
was
you on?
73,000 US.
What page you on there, Mr. Staple?
Page 143.
Okay.
Our audit fees for the current year was 73,000. for
No, that's last
2022.
year's. That's last year's.
For 2022.
Yeah.
And for 2023, it went up to 97,000 US dollars. Why is this so?
Why have our audit fees gone up?
Yes.
Well, that's a good question, Mr. Staple. You know. However, I think I can explain it. The work, frankly, auditing our business has gotten a bit more complicated year over year. And the auditors, frankly, KPMG has been with us from the start. They do a good job in ensuring not just that our numbers, once we present them, are pristine, but they help guide us in, how we run the business going forward. So we're very happy with the work KPMG does, and we don't think, and it's something we debate, obviously, because we want to keep costs down, but we don't think KPMG is unduly charging us for the hard work that they put in to approve our accounts.
I'm saying, sir, with technology as it is today, it shouldn't be that difficult.
You mean auditors?
Yes.
Again, these are all good points, Mr. Staple. However, like I said, I don't think, frankly, it's something we debate, it's something we keep a keen eye on, but I don't think KPMG is being.
Well, I would like for you to look at those numbers. Sir.
We will keep looking at it. We
Okay.
will definitely keep looking at it.
On the same page, Mr. Chair,
Yes,
what
sir.
is this development? Moving from $464,000
No, $464.
$464 to 28,559 US.
Yeah.
What caused this?
Those are the development costs of Russell Road, Andre. Oh, no, sorry, training. Yes, training. So we talked about people being the base of our pyramid. The pyramid, our resilience, our resilience and profitability.
So the
pyramid.
development money is what?
It's training.
Training.
Just upgrading the skills and capacity of our existing staff and team, which is absolutely critical.
So will we see an increase in it for 2024?
We might. I don't think this is an expense. And again, I don't think we can be accused of being profligate when it comes to expense management, with all due respect. So we watch these things carefully, Mr. Staple. This is not an expense I think we should sort of scrimp on, right? Development of staff and developing capacities with an ever-changing environment, technologically, but just generally, development staff costs is not something we should shortchange, I don't think.
What has led to this management fee increase from 22,000 US to 42,000 US? What caused that?
It could be the addition of our Grand Harbor. Yeah, so we added Grand Harbor, which is, you saw the size of Grand Harbor, massive property, in a great location with, a ton of, supermarkets, big property acquisition there, and that has to be managed. I mean, we managed this $71 million worth of assets with 12 people. So it takes some remote management capacity as well to get this done efficiently, but it costs us, right? So that is the main reason for that big jump in management fees.
And lastly, Mr. Chair, while we appreciate the dividend payments, we are expecting higher dividend payments.
Yes. Again, an excellent point. As you can see from the presentation, Mr. Staple, we did $1.4 million last year. The goal is to get you $2 million in dividends, total dividends this year, and that's our target. Next year. Yeah, 25. Sorry, but I mean, if we can do it this year, then all the better.
And lastly, sir, turn it to page 131.
131. Yes.
What account for this group movement of cash flows proceeds from 3,000 to 14,000 or 14 million?
The cash
from 3 million to
inflows.
14
I
million.
think that is cash inflows. That's probably debt. So we acquired that property last year. So that's a sort of tracker of cash in and out from a loan standpoint. So that is, if you notice, that's a loan payable note. So it just sort of tells us the inflows of funds, loan funds, during the year or year over year. And remember, we acquired Grand Harbor last year, so a $15 million property.
So are you going to look at the dividend payments, sir?
Yes, absolutely.
Because
No,
what I'm saying is that as shareholders, we expect a little bit better return on the investment. That we have done.
Absolutely, Mr. Staple. Absolutely. You don't have to tell me twice.
Continue
Say
the good work,
less.
sir.
Yeah, man, sure.
And continue the hard work you and your employees are doing.
Thank you, Mr.
Especially
Staple, as usual.
Kevin,
Yeah, especially Kevin. Yeah, no, absolutely.
he's doing a significant job.
And we're taking care of him accordingly. Trust me, Mr. Thanks, Mr. Staple. I feel like I got off easy there. You're slowing down. Thank you. Yes, ma'am.
Afternoon, everyone. Beverly Gustav is my name, shareholder. I am very proud to be here. This is my first AGM that I have attended, and I am elated because I am in the same field, building and all of that. So I'm really proud of this company. I have lots of stocks, but this is the one I would like to stick with.
Thank you very much,
So,
Red.
yes,
Thank
you
very
have
much.
done
Appreciate
well.
it.
You have done well.
Appreciate it.
I have just two or three questions. One, you have done a lot of development, a lot of building and all of that, but do you ever think of building for tourism or anything like that?
So we haven't done a lot of building, just to be clear. We've stayed
Well, you have
away.
done quite well for yourself.
Well, no. So we acquired existing buildings and
Right,
generated
right,
the cash
yes.
flow from the rents there. So we're not really in the development business, just to be clear. We're sticking our toe in the water here now with Rousseau Road. But I think your question overall is whether we have or have considered investing in the sort of hospitality
building for tourism, yes.
segment. Look, we look at a ton of opportunities, as you can imagine, given the business we are in. The hospitality segment is one we have obviously looked at from time to time. There is a level of potential volatility in that market that doesn't accord with our expectations for being able to generate consistent cash flow and dividends going forward. And so essentially we've not seen an opportunity yet that has met the very exacting standards that Kevin and the rest of the team have established for sort of making an investment. And those aren't going to be cheap, right? I mean, if you get to the hospitality business, you're upwards of 7, 10, and more $1 million. You do that, you really want to be sure that you are holding the right end of the knife, the handle, preferably. And certainly my experience is that the operators of hotel properties, not the owners of the block and steel, make out like bandits, right? And if we look at some of the experience, the recent experience, sorry about the French, but you look at some of the recent experience of some of the bigger players in the market who have gone into the hospitality business, they've struggled and have had to divest themselves of those properties eventually because, like I said, to me, the experience there is if you're an operator where you're just operating and earning a fee and, determining how much you should build and what you should build and somebody else has to put in all that capital, you make out like a bandit. The owners of the capital and the block and steel can struggle, and especially in a higher for longer interest rate environment, again, just doesn't meet the exacting standards Kevin and the team have put up. So far is what I'd say.
Okay.
Yeah.
Well, congratulations, Kevin. You have done quite a fine job from what I have seen. My second question is, you mentioned that you do some involvement in like schools and all of that. Can you expand on that a little more, please?
Well, so so a couple of things. Schools are actually some of our tenants in Cayman, and we have educational facility tenants, but we also support schools around in the communities where some of our buildings are right here in Jamaica, and that's just part of our corporate social responsibility activity. This year and next, I think we ought to explore some more Cayman corporate social responsibility, given that we have such a huge portion of our portfolio in the Cayman Islands as well. So far, we've relegated that work to Jamaica, as we should. We're a Jamaican entity, and this is our home. But we want to expand that. Basically, we have as a strategic focus with education is certainly one of the areas from a corporate social responsibility standpoint we want to focus on. We think it's key. And so it's why we do a lot of work in helping to rehabilitate and support schools.
So do you at any time see yourselves like going into some schools, especially technical schools, to encourage students, because the students are really struggling from my point of view. So they need some mentors. So do you think it would be appropriate then for you, even once in a while, to visit a school and say something that would encourage the students?
It's a great idea.
Yes, for going
great
forward.
Great idea. So Kevin and the team will definitely take that on board. I think it's a great idea. And the more we can do that, the better. Absolutely.
Well, if you think of it, you can let me know. I'm in some of the schools as well.
Okay.
And my last question is, I would like to invest more in this company. So how do I do that?
You can go to our broker, VM Wealth. VM Wealth is here as a broker. You can go to any one of the stockbrokers.
Well, my broker is VM.
Okay. All right. Yeah. Good.
So, okay. Thank you very much.
No,
and
thank you, Reverend.
I am very proud of this company.
Yeah, man. Thanks, Reverend Gustav.
Yeah, morning, Mr. Chairman.
Yeah, man.
Livingston, young.
Yeah, no one well know you, Mr. Livingston.
All right, yeah.
The questions are going to be incisive as usual.
Man, all right. I'm going to big up Mr. Chairman and Mr. Kevin. For running a business nowadays, it's not easy. You have to bust your brain. Well, I mean, not only do it, you have to bust in the brain get shareholder, get money. The next thing, when you see me now, to grow shareholder capital, that's where we can get good dividends and all them things. The next thing, I have a question to ask. The US dollars, when you get when have an account when you're selling properties, and you get the US dollars in there. Mm-hmm. All right. The other thing now, the Jamaican dollar, we have to use it for buy US for purchase US stuff for buy do any development.
Sometimes, I mean, we do get some J dollar rental receipts. Those J dollar rental receipts are adjusted every year. Yeah. More or less at the rate of devaluation, so we're effectively getting a US dollar denominated rate of return on the J dollar. The few J dollars I might add, because most of our rents are received in US dollars, but the few we get are pegged to the US dollar. And so we are rarely out of pocket from our FX exchange rate standpoint. As you can see in our financials, we don't have very much exposure to FX fluctuations. And that was because we converted to being a US dollar denominated entity overall. So we don't have much exposure there at all. We borrow in foreign exchange to get the best rates we can possibly get. And that is largely how we engage in any of our capital deployment.
Yeah, Mr. Chair, because through the decline in the Jamaican dollar 2 years, Jamaican dollar was less than 3 cents to the US dollars. And so in any farm business, if you try to pump up your money, if you get a business flowing, because I don't know why the dollar constantly devalue. Less than 3 cents. Why? If you have $1 billion Jamaican dollar, they didn't have no value. I don't know what problem.
No, $1 billion Jamaican dollars only for money.
I just try to if I buy the Jamaican dollar with the US, your business are good because it don't have any value.
I get your point.
I understand.
I get your point.
You can turn to page 100, please. The thing that's fine, I can hardly see it, Mr. Chairman, so have a go with me here. Page 100, note, I see the note something. It's just page 100. All right, it's a net asset. Your investment property of 50,000.
59.1 million, roughly.
Yeah. Yes. Come here, all you can see it, say, disposal of investment of property.
No, deposit.
Deposit, yeah. You have 2 million something. You have to see with Mr. Chairman.
Yeah, no problem.
Explain to me the group and the company 2021, 2022, 2023, and 2022. You have 2,600,000 and something, and in 2023, they dashed them of what? 18 million? I can't see it,
No, it's 2.7. So both of those. So one just outlines the total value of the investment property that we
Yeah.
have and have invested in. The other one is just outlining the deposit on investment. So we're about to buy a property, you have to make a deposit.
Yeah.
And I suspect that this is talking about our Gumtree property in Cayman. And so the 2.6 to 2.7 just highlights the slight difference year over year in that deposit on the Gumtree property, which went up by a little over 140 grand year over year. So one is just a deposit on property that is waiting now for that balance to be paid over to get the property, which is imminent now, by the way, in this year. And the investment property number is just the total investments that we've made in actual property.
And look, you have a losses on it, Mr. Chairman.
Have a what?
Losses, a profit of losses, or losses, something like that. A 4 million, that's a 4,864,000. That's all? No, this is the same thing, man. Investment.
No, man, no. So those are, so remember the CEO.
Fair value, yes,
The CEO investments at fair value
Right,
through
yeah.
P&L, right? So
Yeah.
the CEO talked about the fact that we have some investment partnerships in some residential properties that I mentioned to Denise earlier in Atlanta.
Okay.
We have 150 odd. We have a partnership in 150 odd unit property and or two really big multi-family residential property units in Atlanta, and that is how those are accounted for there through and the movement in those go through the P&L, which is why that is characterized there.
Jump down a little bit at the bottom part there, the last one. It's a investment in subsidiaries. We see subsidiaries. We see subsidiaries, the dash between.
Yeah, so we have multiple subsidiaries through which we operate in the Cayman Islands, in the U.S. We have a variety of companies that we own 100% of. Your company owns 100% of that operate in these different jurisdictions. Some of them are required to be separate entities, like in the Cayman Islands. We had to open a separate entity there. We have entities domiciled in St. Lucia, in Jamaica, in Miami. And so that's what this is referring to. But we own them 100%. So on consolidation is all one big happy family, basically.
Yeah. We have to invest more in it. We can't lose our phone, Mr.
That's a good point. That's a good point.
Morning, David, your shareholder.
Hey, David.
7 years going.
You mean as a shareholder?
Yeah, remember 2017 AGM?
Yes, I do. So this must be one of the best investments you ever made, David.
Let's continue. So during Q1, the company incorporated a subsidiary in the KPREIT UK. That's the UK subsidiary, right, based in the UK?
Yes.
No, last year you mentioned that, I should say Kevin mentioned that, they're looking to go into, you guys are looking to go into the UK based on, the opportunities you foresaw at the time, political instability and so forth. We're now seeing an election being called for July 4 in the UK, which is just insane. But apart from the point, what deal do you see within the remainder of the year that you expect to actually complete in terms of the UK venture? Because to incorporate a subsidiary means that there is something on the table that you're likely to close very shortly.
Right. So no, not necessarily. A couple of things. So we do like the UK market for a variety of reasons. Not the least of which is that the economy is turning and moving, we believe, in the right direction. You're right, an election has been an election has been called. But we think the fundamentals of that market continue to move in a positive direction. Kevin mentioned that interest rates there, because of the election, are being or a movement in interest rates are being held off on. But we think the writing's on the wall there based on the activity that's occurred already in the European central bank side of the market. So we like that economy. We like that. We like the business, we like the commercial real estate potential there going forward, but not just that, the ability to convert commercial real estate to residential real estate there, which is a huge, we believe, benefit going forward and can be hugely accretive for shareholders. So it's not just a focus on the commercial real estate business, but the ability to convert to residential, which is in short supply, as usual, as it is in a lot of these first world markets, right? And so, having sort of believed that, incorporating a UK subsidiary was just a prudent way of ensuring that when it is time to pull a trigger, not just in the UK, but European market, but in the UK in particular, it's just good to have a UK business set up already, a UK company set up already in order to pull that trigger. It's just hugely efficient compared to being a foreign entity trying to buy in the UK. So we've just sort of, been preemptive in ensuring that when we need to, if and when we need to pull our trigger, we're going to be able to do it very efficiently.
No, I get that. It's basically asset structure in effect. So you mentioned that, when you're ready to pull the trigger, so is it that you're not likely to foresee a deal closure later this year as yet, or?
Well, we're actively, I'll say actively one last time, pursuing opportunities in multiple jurisdictions. One of which, as we have telegraphed so far, is the UK market. Obviously we can't make insiders out of everybody here today. So suffice to say, I can't say any more than that. But we've telegraphed the fact, as you can see and as is clear from our releases, that we've established a UK subsidiary. So, that should telegraph something.
Great. So you had the certificate of occupancy received for the mixed-use development in the Cayman Islands during Q1. And in the Q1 report, you said that it should, try to contribute within the Q2 period. So, with respect to that development, when is it likely that you're going to pay the remaining deposit for that property, and when is it expected to really start to contribute to the P&L if it already hasn't started as yet?
Yeah, no, that is imminent. It's a good question. We've been working fairly assiduously at getting that deal done. So we expect that now to be imminent. In other words, certainly I expect that the next time we meet here, we're going to be talking about the accretive returns from that property for sure. Next time we meet here, which is going to be next year, we're definitely going to be talking about how much we've managed to yield from that business. As far as when that deal is going to be done and tied up, all I can say is it's really imminent now. I mean, we've gotten pretty much past all of the hurdles that had sort of popped up with respect to that transaction. It is imminent, David. We're pretty much going close on that imminently. You soon hear a release on that.
Understood. And earlier this year, the company would have announced a plan to do a share buyback scheme again over a 1-year period. And in the past, company has not necessarily met some of the buyback expectation targets. Well, not targets, but it's been relatively below that threshold that should have been approved by the board. So, and then this new buyback program, do you foresee, the potential to be more aggressive in that buyback strategy?
Well, David, I hope so. No, I'm kidding. So all we've done this year is renewed our buyback scheme details with the stock exchange, which is something we have to do. So we renewed it. We've established pretty much the same, more or less the same parameters. Whether we're going to be aggressive or not is just going to be based on market conditions, right? One of the things we just couldn't sit by as stewards of this business and abide is seeing the trades, some of the trades that were happening well below book value. And we're not going to sit around and see, like multiple trades happening at, orders of magnitude below book value. So we've established a share buyback program. We're watching the market where we think there is opportunity to pick up volume at well below book. We're going to go out there and do it. True, we haven't met some of the sort of parameters that we've set up for it before with respect to the total amount of money we're going to commit. We haven't spent that amount in the past, but that's because those are just parameters, right? But we're going to watch the market, and you don't want to go in the market and start driving the price back up again, or the price you have to buy at back up again. So you really want to just watch the market and make sure that you're getting the best deal you can for shareholders. Because at the end of the day, that's why we're doing it. We think it's accretive to shareholders when you're able to buy back our shares at below book value.
So, just
well, buy back and retire those shares at below book value.
of course. So there's another question. Well, two-sided question. So you mentioned the Rousseau development earlier. This was announced probably like 2 years ago in a sense. You acquired properties, a joint venture. Like when is that? You say mentioning it's the NEPA approvals and so forth. So when is it really likely to start? And like what is the cost? And in this case, KPREIT's contribution to that expected development?
Right. So we own it 100%. We just got complete approval. Either early this year or the end of last year, in December. And so we are proceeding now to final contract with a contractor. I'm not going to tell you the sort of construction number right now, but suffice to say that it is in accordance with our projections, right? You have to project this stuff first and then go out and execute. What it looks like we're going to have to spend now to get this up, running, and sold off is more or less in accordance with what our projections were. And even if we have to make some slight adjustments, they will be in line with the expected returns that we have for development investments such as this. You can rest assured.
And then, just to follow up on that point, so would KPREIT actually explore more sale and leaseback transactions as a way to, get control in a sense of some great valued properties and benefit from that contractual cash flow arrangement?
Yes, absolutely. As the CEO, as Kevin mentioned, stay tuned. You're probably going to hear an announcement on that fairly soon.
Understood. And then, just probably 3 final points. So, the audit fees for the company particularly by 24%, which would have been impacted, by a couple of things at the time. You'd have had potentially a couple more properties on your books, the additional investments, that's one thing in terms of scope, and the increase in audit fees on their side. So the better question is what has the 2023 audit cost really come out to be in a sense? Is it much more materially higher than last year?
I don't think it's materially higher.
CFO?
No. CFO's over there, Andre. But no, it's not materially higher. No. Why are you thinking it's materially higher? It's higher. Well, it's not materially.
No, KPMG charging more and they have less clients, so.
Yeah. So look, David, when you show me a public company that has audit fees that are less 1 year over the prior year, come tell me, right? I've never, in my 30 years of commercial experience, see audit fees come down. That just don't happen. However, what you have to assess is whether you're getting value for money at the end of the day. And like I said, I think we are. I think we definitely are.
So just at the second final point, insurance costs have gone tremendously through the roof. And in the case of KPREIT, the company, you would have seen your insurance fees go from $84,000 US to about $125,000 US, about a 50% year-over-year jump. So
that's because of the acquisition. I remember I had a big acquisition, a $15 million acquisition of Grand Harbor, right?
I'm talking about the company in this case. I didn't refer to the group a while ago.
Okay, so when you say you're referring to the company, you're saying that doesn't.
I referred to the company
include
financials. I didn't refer to the group financials a while ago. For the group, that cost would have increased from $116,000 US to $162,000 US.
Yeah. So that's really where you want to sort of look is, the overall jump in insurance costs. And like I said, we added a fairly significant asset to the portfolio, which has to be insured.
No, of course. So the better question is, going into this year, what has your what has your experience been in terms of renewing your reinsurance policy, sorry, your insurance policies this year, considering that, reinsurers didn't give as much a hard time to insurers this year in the region?
Look, it's one of the expenses that we have to manage and manage carefully. You are right. I mean, if the point you're making is that insurance and reinsurance rates have exploded and are expected to continue to explode given, the climate and other issues that are impacting economies far and wide, yeah, that's clearly something we have to be concerned about. But again, if you look at the movement in OPEX, which includes insurance expense relative to the move in revenue, I think we're managing that ratio properly, and we're going to continue to manage it properly, though we can't get out of insuring properties, right?
No, that's
so we have to do that. But again, what you want to make sure of is that the revenue you're generating from these properties by improving them so that you can improve rent receipts from them are going to properly accord with the rate of return that we're looking to generate for shareholders.
All right, so I know you said, it's my final point. I know you said earlier, stay tuned.
Yes.
But with respect to Bill, as I was saying, no.
Yeah, all right, Dave. Yeah, just let David finish now.
As I was saying, so earlier you said stay tuned, and this comes back to the point, with you mentioning the CPI numbers earlier today. So with respect to, the expected reduction in rates over the next 2 years, do you foresee, KPREIT seizing more capital market avenues to really grow that balance sheet pretty aggressively to that $100 million US target? Because 2025 is only next year.
Yeah. Well, no, Kevin said it. I mean, there's no way to get to $100 million in assets without some capital market transaction, and so we're exploring all the possibilities. I mean, there's debt, obviously, and then there's equity. Equity could be dilutive, depending on the price we come to the market at. Debt, we just can't have it be very expensive at all, right?
What about intermediary structures like mezzanine or pref shares?
No, sure, exactly. I mean, that is something we are constantly looking to explore. And again, I mean, if you look at our capital management sort of initiatives over the past, I think it'd be fair to say that we've managed them pretty well. And we're going to continue to do that, managing the cost of any debt against sort of the returns we're going to be able to get, or the dilutive effect potentially of straight equity type capital market transaction. Either way, on the equity side, like Kevin showed you, our pre-APO, last APO appreciation in price has been 13 or 14% or thereabouts. So I think we managed that pretty well. And, if you look at our debt to equity capital, debt equity asset, investment asset ratios, prudent, and our cost of funding that while going up, total cost relative to total revenue growth, I think has been in check. So, I think we're doing a good job, David.
Thanks, Garfield. And Roxanne Michael is the next question.
Yeah, man, sure.
Morning, everyone.
Morning, Roxanne.
I'm Roxanne Michael, shareholder. I promise I won't be long. All right, so I have 2 questions. How would you like the format? Would you like me to ask the question and you answer, or you want me to ask both questions and you answer?
No, one at a time, beg you.
One at a time? Okay,
Yeah.
good. All right, so first before I begin, I want to commend you and your team for doing an awesome job. Well done,
Thank you.
well done. I'm
Thank you.
a proud shareholder.
Thank you.
All right, so with the emergence of advanced technology and AI, how does the company plan to leverage technology to enhance property management and tenant satisfaction?
That is an excellent question. I think we should have our CEO come up here and talk about the leveraging of technology, which is definitely topical. Kevin?
Roxanne, is almost like you're in my mind.
Oh my God.
Because I was actually having a conversation with something I'm trying to, we talk about training and development, and I'm actually talking to someone about doing a presentation to the board on AI. But we have been doing a lot of research on that, and we know that there are lots of opportunities in terms of AI and how it can help us in not only just property management, but also just how we manage our business overall, because there are elements of it in terms of corporate governance, and we are looking at some of those strategies. we know that AI, the main component of AI is that it ends up replacing an individual. There are some things that individuals can do that AI can't do, and there's some things that AI is important in terms of making us a lot more efficient. And as you can see by the number of people we have managing the business, we like to keep the number of persons at a low level, so we use technology as much as we can in our business. So this is actually something that we're focusing on.
Okay, awesome. All right, so the next question. Can you share some insights? Can you share some insights or an overview, thank you, of the strategies in place to mitigate risk associated with property management, property investments, and the operations of the company? So in other words, I'm asking, what are some of the tools that you use to identify and mitigate risk, given the economic climate? How do you manage your risk?
So Roxanne, if you go in the annual report,
Unfortunately, I did not get a copy.
you didn't get. All right, we'll ensure you get one.
Okay.
But we have a whole section that talks not only we not only identify. See, I'm pretending to be as tall as the chairman.
Yes.
Not only identify. It's on page 79.
Yes.
Going forward, we identify the risks that we see in the business, and we also talk about the mitigation strategies as well. The mitigation starts on page 84. It's very extensive, so we couldn't go through all of this today. But what I would say is that if you go through this and you have further questions, feel free to reach out to us.
All right, thank you.
All right, you're welcome.
Have a good day.
Mr. Chair.
Notice I don't venture into areas where I don't have any
Mr. Chair.
expertise at all. Yes, sir.
Our transactions are always taking into consideration US dollars. Am I correct?
Yes.
Now, the US dollar is becoming under severe strain internationally. What are we trying to do as far as that is concerned?
No, I don't know if I'd agree that the US dollar is coming under severe strain. The US fiscal situation is coming under increasing scrutiny given the level of their debt and their debt to GDP numbers. But I wouldn't say the dollar's coming under strain. In fact, the dollar's actually fairly robust compared to its sort of first world counterparts for a ton of reasons, right? The US, after World War II, essentially made their currency the reserve currency of the world. So they have a very unique position that allows them to borrow almost ad infinitum because everybody sells them stuff, gets their dollars. They have nothing more to do with it than invest right back into the US, right? Oil and energy transactions are all virtually denominated in US dollars, so they're in an enviable position. So I wouldn't worry too much, despite the idea somehow that the US dollar is under some kind of demise. I think that is exaggerated. The US fiscal situation, though, is a cause for concern. But again, the size, dynamism, innovation, and just productivity in that economy leads certainly me to believe that them going figure out the fiscal situation.
So as far as you're concerned, then, Mr. Chair, the US dollars is okay.
Yes, sir. I mean, as far as any fiat currency goes on the planet, yeah, I'm a fan of the US dollar. So
the other thing, why is it that the auditor's report was not read?
That's coming next. It's coming next. It's coming next. It's after the question and answer.
Okay.
Yeah, man.
Okay. Thank you.
And we're not going to task our auditors too much today, right?
What I want you to do is to make sure that that cost is reduced.
Yes, right. Yes, heard that, Mr. Staple. Heard that loud and clear. All right, one final question, beg you, from.
Thank you, Mr. Chairman. Marty Fennell.
Yes, Mr. Fennell.
Based on your answer a while ago about the US dollars,
yes,
I believe your stock could increase by about 10 folds.
If?
From $8 to $80. If you pay your dividends in US dollars.
We do. We do.
I get my dividends in Jamaican dollars.
Well, that's because you've elected to. That's because you've elected to, Mr. Fennell.
I elected to.
Yes.
Okay. So I can get it
Probably unbeknownst to you.
unbeknownst to me,
Yeah, yeah.
possibly.
But you can receive. We pay them in US dollars.
US dollars. I would love
Yes,
mine
sir.
in US dollars.
Sorry?
I would love mine in US dollars.
Well, just change that mandate with your broker because
Okay.
we pay them in US dollars
Very
every
good, very good,
time
very
and
good.
always have, by the way.
Secondly, could you, somewhere in your report, state the rate of exchange you use? When I get my dividends from the bankers, it's in Jamaican dollars, as we just said, but I'm not too sure. When I work out the rate, I'm getting something like 147, which is kind of low.
No, you're getting right. Yeah, you're getting.
There's a cash rate, that's the problem. So instead of you getting the US dollars in your account and it's in the bank's buy draft rate, they're being given a cash rate, which is where you get
So 147 is the more or less that.
It depends on the bank.
Okay.
Yeah, Mr. Fennell. So look, you can get rid of that problem by just changing your mandate to
Change
get
the
in
mandate.
US dollars. Sir. Yeah.
Okay, thanks for the information.
Yeah, man. Sure thing, sir.
Last one. Mr. Chairman,
Mr.
2020,
Livingston.
yeah, 2020, me say make 22 million. You make more than the 22 because you have to take tax out of this, you know, the 22 million. The gentleman was talking about. You take, after the tax, take out the 22 million. How much you have left? Or you make more.
22 million. What kind of dollars? When you
Profit,
talking
profit.
No,
Like
man,
the gentleman talked about.
No, man, we made four. We did 4.8 million in profit last year.
And when you take tax out of it?
And yeah, after tax, that number was, and by the way, we are probably one of the more tax efficient public companies around from an effective tax rate standpoint. But the net tax position after that is, so we did 4.6 million, sorry.
Yeah.
And
you take tax out of it.
And we, after taxes on it, group-wise, we still generated 4.6 million in profit. So we're very tax efficient, extremely tax efficient.
So you can just talk about 22 million in
I don't know where you get 22 million from. We did 4.6 million last year, 4.66 million before tax, and 4.64 million after tax.
All right, Mr. Chair.
Yeah, man. All right, so,
One last question.
Yeah, man, sure.
Wesley Thomas.
Hey, Wesley.
You mentioned that you might be going into the UK economy and perhaps Europe. I know the European Central Bank has just recently cut their rates,
Yes.
and the UK may follow suit. We've got the election on the 4th of July this year. I want to know, why has it taken you so long to enter that market? And that's me personally, because the UK property prices, commercial or otherwise, it's still on the increase, still going up.
Sure.
I think you should have started then when we moved away from Brexit. That's me personally. Yeah? It's a bit late. Me personally think that. Yeah? Secondly, second question, why have you heavily invested in the Cayman Islands, 55% of your portfolio? Why so much in the Cayman Islands? Yeah? And
Yeah.
that's what I want to know.
Okay, cool.
And lastly, you're trying to get to a portfolio of 80 million by 2024, or your entire property portfolio.
Well, it's 100 million by 25,
Yeah,
actually.
but by 2024, you mentioned around 80,
Oh, okay,
100
yeah.
million, yeah? 2024 is next year.
It's this year.
Oh, sorry, 2025 by next year. Sorry, my mistake. Are you thinking of doing another APO? The last APO was, what, 3 years ago?
Yeah.
Something like that?
2 years ago.
2 years ago. So are you looking at those angles? That's my question. Yeah?
Possibly.
Yeah?
Well, I mean, the chairman just mentioned that we're looking at different Yeah, I'd mentioned we're looking at different capital market activities. So it could be equity, it could be quasi-debt, it could be debt, but we're looking at different options to increase the portfolio to 100 million. So we're not ruling out equity.
By 2025.
By 2025. So
Okay.
next 18 months.
All right. Okay.
Yeah, thanks, Kev. So first question was, why have we gone into the UK market before?
Why so late?
Look, there's no time like the present, right? True. We should have sort of had the
much
foresight.
earlier.
Yeah, we should have the foresight to jump in right after Brexit. But at the time of Brexit, if you recall, that's followed by a global pandemic. It was not really the time to be thinking about sort of expanding. Certainly from where we sat. Certainly from where
that was the time to think and go into it.
No, sure. Well, I suspect that's a bit of Monday morning quarterbacking. If you recall the time of Brexit, of the pandemic, nobody was thinking, all right, maybe, sure.
I was thinking that way.
Sure, about your capital.
Yes.
Yeah, about your capital. But when you're the steward of other people's capital, respectfully, I don't think you can be as cavalier. And I think we rightfully thought, you know what, let us be as conservative as possible. Let us husband cash and liquid resources because we don't know how long this is going to last, how devastating this is going to be on economies going forward. So we were a little more conservative than we probably should have been. To your point, we probably could have been a bit more aggressive, thinking, all right, this is really the way to sort of make gains in the future from a depressed property, or as depressed as it's going to be, property market in the UK. We didn't. However, like you, we still believe that there is value to be had in that market. There is upside to be had in that market. You said there's an election coming up. I think we have a general sense for where the votes are going to come down there. Everything suggests that if that happens, we're going to get a cut in rates and a bit of a stimulus to the economy. So we don't think this is a bad time to be going into that market, so we're going to go. On the Cayman side, Cayman's just a firing economy. GDP growth last year, 2.3%. The unemployment rate is 2.2%. Their current account, which is crucial for small islands like that. The current account balance of payments is 10.5% of GDP. Ours is in Jamaica, supposedly a flying economy, and it is. We're doing as good here as we've ever done. We have a current account as a percentage GDP deficit, right? So Cayman's a firing economy, growing every day. Expats are piling in there. The demand for commercial and residential real estate is just exploding. They have more companies incorporated there than people. They just do. It's their biggest, so we are high. No, I will say that not everybody on our board of directors is equally enamored of this market, and it's it's an ongoing debate. And frankly, we don't want to be over committed to any particular market, which is why Kevin mentioned that we are going to diversify. We're actually selling now. We're not waiting for a downturn or anything. We're actually selling properties now, actively marketing properties there now for sale in order to geographically diversify out of that market. So we're not wedded to it, but as Caribbean markets and economies go, there's not a ton better in the region.
Okay, thank you.
All right, yeah, great. All right, so now, thank you for all of the... I wouldn't say that. I wouldn't go that far. All right. So thank you for all of those questions. We're now going to ask KPMG to come up and read the audit report for us. I'm not. You're not. We have to read the whole. You're not. Sorry.
Good afternoon, everyone. Independent Auditor's Report to the members of Kingston Properties Limited. Report on the audit of the financial statements. Opinion. We have audited the separate financial statements of Kingston Properties Limited, the company, and the consolidated financial statements of the company and its subsidiaries, the group, set out on pages 8 to 50, which comprise the group's and the company's statements of financial position as of December 31, 2023, the group's and the company's statement of profit or loss and other comprehensive income, changes in equity and cash flows for the year then ended, and notes comprising material accounting policies and other explanatory information. In our opinion, the accompanying financial statements give a true and fair view of the financial position of the group and the company as at December 31, 2023, and of the group's and the company's financial performance and cash flows for the year then ended in accordance with IFRS accounting standards as issued by the International Accounting Standards Board, IFRS accounting standards, and the Jamaican Companies Act. Basis for opinion. We conducted our audits in accordance with international standards on auditing, ISOs. Our responsibilities under those standards are further described in the auditor's responsibilities for the audit of the financial statements section of our report. We are independent of the company and the group in accordance with the International Ethics Standards Board for Accountants International Code of Ethics for Professional Accountants, including International Independent Standards, IESBA Code, and we fulfill our other ethical responsibilities in accordance with the IESBA Code. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Key audit matters. Key audit matters are those matters that, in our professional judgment, were of most significance in our audit of the financial statements of the current year. These matters were addressed in the context of our audit of the financial statements as a whole and informing our opinion thereon, and we do not provide a separate opinion on these matters. Key audit matters and how they were addressed in our audit. Number 1, valuation of investment property. See notes 3M and 11 for further disclosures. Investment property, group, $59,178,916. 2021, $40,137,529, and company, $18,223,782. 2022, $14,347,763. The valuation of the group, including the company's investment property, requires significant estimation given the infrequency of trades in comparable properties in other cases and the absence of a number of observable recent market prices. Significant judgment is used by the group in arriving at the fair value of these properties, the fair value of which is impacted by uncertainty of market factors, pricing assumptions, and general business and economic conditions used in valuing these properties. As part of our audit procedures, our response to this matter included the following. We used our own valuation specialist to assist us in assessing the reasonableness of the valuation methodologies employed by management, including management experts, where applicable, and the fair value conclusions for a sample of properties at the valuation date. We consider the provision of the applicable financial reporting framework in order to evaluate the adequacy and appropriateness of those disclosures, assessed the sources of data, and challenged the underlying assumptions utilized to value the properties. Performed a search for similar transactions and listings to assess potential fair value changes that occurred within that period. The group uses its judgment in selecting the appropriate valuation techniques to determine fair value of financial instruments. The estimates of the fair value arrived at may be significantly different from the actual price of the instrument in an actual arm's length transaction. The valuation of the group's unquoted investments has been identified as an area of significant risk, given that the measurement of the unquoted investments includes significant assumptions and judgments about expected cash flows and the determination of the discount rate to be applied. The group has determined the fair value of the unquoted investments using the income capitalization approach in the absence of a quoted price for the instrument on a trading market. As part of our audit procedures, we included the following. We used our own valuation specialist to assist us to evaluate the application of the valuation methodology and the reasonableness of the assumption used in determining the discount rate by comparing the discount rate with published market and industry data and other relevant information. We assessed the reasonableness of the cash flow projection by, first of all, comparing the input data provided by management with independent data sources, such as the discount rate and rates of return, supporting documents, financial statements of the investment company, and information. And secondly, challenging the group's assumptions, such as the timing of the amounts and future growth of the cash flows, by obtaining an understanding of the relevant activities of the investee, evaluating historical performance and financial position, using our knowledge of the industry in which the investee functions, and determining whether there may be variations to the contractual cash flows expected based on the knowledge obtained from our evaluation of the investee. We assess the adequacy and appropriateness of the group's disclosures against the requirements of IFRS 13, fair value measurement, and IAS 1, presentation of financial statements, see notes 12 and 27, to determine if these adequately illustrate the key risk discussed in the key audit matter. Other information. Management is responsible for the other information, and the other information comprises the information included in the annual report, but does not include the financial statements and our auditor's report thereon, including the group's chairman and the CEO statements, quick facts, director's report, 10-year financial statements, management discussion and analysis, corporate data, environmental, social, and governance report. The annual report is expected to be made available to us after the date of the auditor's report. Our opinion on the financial statement does not cover the other information, and we will not express any form of assurance conclusion thereon. In connection with our audit of the financial statements, our responsibility is to read the other information identified above when it becomes available, and in doing so, consider whether the other information is materially inconsistent with the financial statements or our knowledge obtained in the audit, or otherwise appears to be materially misstated. When we read the annual report, if we conclude that there is a material misstatement therein, we are required to communicate the matter to the Board of Directors. Responsibility of management and the Board of Directors for the financial statements. Management is responsible for the preparation of financial statements that give a true and fair view in accordance with IFRS accounting standards and the Jamaican Companies Act, and for such internal control as management determines is necessary to enable the preparation of financial statements that are free from material misstatement, whether due to fraud or error. In preparing the financial statements, management is responsible for assessing the company's ability to continue as a going concern, disclosing as applicable matters relating to going concern, and using the going concern basis of accounting unless management either intends to liquidate the company or to cease operations or has no realistic alternative but to do so. The Board of Directors is responsible for overseeing the group's financial reporting process. Page 5. Auditor's responsibilities for the audit of the financial statements. Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Reasonable assurance is a high level of assurance, but not a guarantee that an audit conducted in accordance with ISOs will always detect a material misstatement when it exists. Misstatements can either arise from fraud or error and are considered material if, individually or in the aggregate, they could reasonably be expected to influence economic decisions of the users taken on the basis of these financial statements. A further description of our responsibilities for the audit of the financial statements is included in the appendix to the auditor's report, and this description is located at pages 6 to 7, which forms part of the auditor's report. Report on additional matters as required by the Jamaican Companies Act. We have obtained all the information and explanations which, to the best of our knowledge and belief, were necessary for the purpose of our audit. In our opinion, proper accounting records have been maintained so far as appears from our examination of those records, and the financial statements, which are in agreement therewith, give the information required by the Jamaican Companies Act in the manner required. The engagement partner on the audit resulting in this independent auditor's report is Karen Ruggabear Singh. Signed by KPMG Chartered Accountants, Kingston, Jamaica, February 29, 2024.
Thank you, Karen. That is, yeah, no, she deserves a round of applause. Please give Karen for having had to read that entire thing. Well done, Karen, as usual. See, when you talk about audit fees, I mean, you know. So we are at the point now where we're going to take the various resolutions, the business of which this AGM is all about, starting with resolution number 1, to receive the audited accounts for the year ended December 31st, 2023, and the reports of the directors and auditors. The company is asked to consider, and if thought fit, pass the following resolution. Resolution 1, that the audited accounts for the year ended December 31, 2023, along with the reports of directors and auditors circulated with notice convening the meeting, be and are hereby adopted. Can I have a proposer, Mr. Stable? A seconder? Thank you, Reverend. Reverend Gustav, yes, thank you. Oh, Reverend Lee. I thought it was Reverend. I'm sorry, Reverend. Sorry, Reverend. It sounds like Reverend. Do we, okay, those in favor? Any opposed? Any abstentions? No, the ayes have it. Thank you very much. The second resolution to declare final dividend. The company is asked to consider and if thought fit pass the following resolution. Resolution 2, that the interim dividend of US $0.00075 US per share paid on May 30th, 2023, and the US $0.000797 per share paid on November 23rd, 2023, be and are hereby declared as final for the year ended December 31st, 2023. Can I have a proposer? Roxanne Smykel proposes. David Rose second. Can I have the ayes? Any nays? Is that a no? You're against approving this as final? No, yeah, but we went through that. Are you? All right, absolutely. So we have a single nay, but the ayes have it there.
Mr. Chair, I'm against that.
You're against what?
Pay that dividend. I think it could be higher.
You're against having this. you're against this being the final, those two dividends being the final dividend for December 2023, because that's all we're voting on, that those be the final for the last financial year. You would like another dividend to be paid for the last financial year? Yes. Yeah. All right, so there are two no's. Not only, it's not operationally possible to do that. No, I hear that, and we've taken that on board. But that's not operationally possible to pay that retroactive dividend now for the prior financial year. It's just not, Mr. Staple. Eh? No, but we're talking just about 2023 here now. So you're still objecting to the 2023 final dividend? All right, so we've got two objections, but the ayes still have it, Mr. Staple. Thanks. And the need to pay more dividends going forward is understood. Resolution number 3, the directors retiring to re-elect directors. The directors retiring by rotation in accordance with Article 107 of the company's Article of Incorporation are Mr. Philip Silvera and Mr. Resworth Burchinson, who, being eligible for re-election, offer themselves for re-election. The company is asked to consider, and if thought fit, pass the following resolutions: that Mr. Philip Silvera, retiring by rotation, be and is hereby re-elected. Let's do them one at a time. Can I have a motion, a proposer, a seconder? The proposer is David Rose. The seconder is Mr. Orrit Staple. All those in favor? All those against? The ayes have it. Resolution number 4, that Mr. Resworth Burchinson, retiring by rotation, be and is hereby re-elected. Can I have a proposer? Mr. Staple, I think. Roxanne Smichael proposes, seconded by Mr. Orrit Staple. Those in favor? Aye. Those opposed? The ayes have it. Thank you. The 4th resolution, to appoint the auditors and fix their remuneration. The company is asked to consider, and if thought fit, pass the following resolution, and I recommend it, that KPMG, having signified their willingness to continue in office as auditors, the directors be and are hereby authorized to agree to their remuneration in respect of the period ending with the next annual general meeting. Can I have a proposer? Beverly Gustav propose. Beverly. I don't know why I keep saying Beverly. I don't know why I heard Reverend. No, I'm hearing Beverly. Beverly Gustav proposes, seconded by Mr. Livingston. All in favor? Aye. All opposed? The ayes have it. Thank you very much. And then the 5th, to transact any other ordinary business of the company. That's not a resolution. Okay, good news. All right. Thank you again, stakeholders and shareholders. That concludes, I believe, the official part of this presentation. Really appreciate it. Hope you appreciate the progress of your company, and look forward to seeing you all next year and to you buying more shares this year of the company. Thank you. Sorry, before. And seconded by Yaber. All those in favor? Aye. Those opposed? The meeting is adjourned. Thank you.